first rates Wednesday morning, and the first rates are wow. The index of 19,000. If you have a 6-point change, you actually would say it's like no go, so to speak. The breadth is looking good, and that I think is important. What is interesting for me is that the power stocks have started correcting. I don't think I'm missing on anything here, but Suzlon is down, Ratan India Power is down. You've got Orient Power Green, that is down. Reliance Power is down. IDBI Bank, where it is obvious that the disinvestment which we've been reporting that is not going to go through. It is on the back burner now. That stock, because of the weight of what is happening in terms of the expectation versus reality, that the stock I think has not collapsed, but it is down. But the breadth today in terms of Suzlon, Vodafone, Yes Bank, Orient Green, Reliance Power, all of them are trading with a downward bias. Nothing in the power sector, Nisha, right? But the stocks are down.
Yeah, nothing specific in terms of news flow. It's just, I think, some sort of profit booking, because all of these stocks have had a solid run, and that seems to be the nature in the market today. A bit of profit booking, a bit of consolidation. Let's take a look at some of the news makers. TCS, that provision hit of $125 million was expected to have a sentiment impact. Yes, we are seeing that on the stock. Texmaco as well, wherein the QIP of 750 crore has been launched at almost 13% discount. It's actually managing to hold up okay. You also had IIFL Finance came up with that FY25 guidance of theirs. It was a decent kind of show in terms of the expectation going forward. Pretty much flat for the trading session. All Cargo Logistics, wherein the numbers for the month of October did not look very impressive. It was actually down 4% on a year-on-year basis. And the New Grow as well, wherein RBI circular impact they had envisaged will not have any impact on ROE and ROA, was also going to be in focus. Polycab and RR Cable and KEI, these are some of the cable companies we want to put the spotlight on. Of course, there was that Goldman note as well that came in, but these stocks had a good run in the trading session yesterday. Not a lot of these big buzzers, to be honest with you. It's Tata Investments, which is up 2.5%. KPR Mill has opened up in the green. You also have CSC, Suven Pharma. These are the stocks which are doing well. KPIT continues to see a slide. It's actually 5% lower. Remember, yesterday that stock had slipped 7%. Today it's starting with a gap down of almost 3 to 4%, so watch out for that. And then BSE is the other one. Within sectors, Avan, I think it's only Pharma which is standing out. That's at record high level, and some of the energy names because of the Phillip and BPCL, because rest of the sectors, including real estate, is on the back foot.
Yeah, that's the biggest drag today. And then media is not doing a whole lot. And yep, you fagged off financials, absolutely quiet, lingering around the 43,640 mark. Yes, it is energy, auto to a certain extent. But the market's absolutely flat. But take a look at that breadth. That's in favor of the gaining side. So what do you make of that, Kunal?
Yeah, so I think it's an okay start on the index. We are still hovering around the 90,800 mark for the Nifty. The Bank Nifty is underperforming, and I think that's been the script over the last, I think, few trading sessions. Reliance Industries is something which I would be keenly looking out for, specifically after yesterday's breakout about that 2350 mark. So that's the stock which I've picked up for the opening trade.
Okay, but Kunal, actually, I wanted your take regarding KPIT Tech as well. After this, cut off almost 5% today, 7% yesterday. What would be your recommendation?
See, I think the stock would probably sooner or later get into a bottom formation zone. So what was happening earlier, Anisha, when the stock was at 1640 levels, the 200-day moving average for the stock was almost at a 64-65% divergence from the stock price. Now, when the stock comes closer to that 1400, 1350 mark, the divergence would get narrowed significantly, and it would also coincide somewhere around the 50-day moving average for KPIT Tech. I think that would be a good zone to try and buy the stock.
Nuresh, your first trades?
So that would be a buy on Ashok Leyland, expecting this to slowly and steadily go towards the 190 mark.
Well, Dinshaw Rani joins us. Let's connect with him and talk about markets. How is the new mutual fund going? Have they allocated all the capital? Last time we invited him for lunch at our office, and I'm still awaiting an invite for coffee at his office, which continues. What can I say, Dinshaw? लंच खिलाया मगर कॉफी का इनवाइट नहीं आया. दिवाली हो गई, मिठाई नहीं आई.
Because you're always welcome to our office. Whenever you are this part of town, you can always call up and you can always light up. So,
there has to be a formal invitation. It looks like I'm self-inviting myself.
No. You are a very busy man, so that's what I'm doing.
Okay, what's been your market approach? I mean, let's first start with the fund. You've raised money, and have you started allocating the capital, or are you sitting on cash?
Nikunj, we are very different from the rest of the players, I guess, because when we got the money, as we were getting in the money, we were investing. In fact, we opened when we opened NAV on 15th, we were fully invested. There was 98% invested or so, and we're very clear. We're very clear on the market. So the biggest concern in the market was obviously the US Treasury yields, the 10-year bond yields, which were like shooting up. In fact, there was a term for that, which was called as bear steepening of the curve, and the 10-year yields difference between 2 and 10 shot up to almost around 120, 130 bips in June, but then narrowed down to almost 10 bips before we launch our fund. But that, fortunately, as gap has again opened up. In fact, the US 10-year yields have come down to 4.4% from 5 that they had hit. So that gave us a lot of comfort that one big competitor in the market for money was obviously becoming a bit more, a very unattractive player for Indian equities and such. So that is what drove us to increase our weightages. In fact, get fully invested as such. So that is where we are. Another big overhang has been obviously the local elections, 5 state elections that are going to happen. But I think that's already the market's building in a lot in that. And anyway, the biggest one is going to be the May one, which is the central elections. I think maybe that is why most of the market is going sideways today as such, maybe waiting for those kind of events to play out. But we are very clear, we are stock pickers, and that is what we like to do.
The fact that you've invested 90%, 98% of your total corpus means that you see value in the market. The general argument is that there is no value in the market. Sliver of the market is looking okay in terms of value. So what has prompted you to invest 98% and where have you invested?
So basically, because as I said, that we are stock pickers. We always look for pockets within the market. In fact, whenever the markets are flatlining, that is the best time you can really, take your bets on. You have the time to evaluate your stock. You have enough time to gather your stock whenever you want, whichever one which you like. So that is what we like. And I think this was a perfect opportunity. The market corrected by the time we came up with our NFO and probably invested at the right time as such, I guess, keeping my fingers crossed here. But yeah, so that is how it is. Our probably 2/3 of our portfolio is in large caps and 1/3 today is in mid and small caps. Our sector preferences are quite clear. Right? You also know this. We've been saying this all along that it's mainly financials and consumption. Again, consumption is mainly discretionary, and we have a very broad brush kind of a. When we say consumption, it's a very broad brush kind of a explanation because we also include hotels and real estate and stuff like that in that. So those are the kind of plays we are working with as such. So that's where we are today.
Yeah, we all know your love for financials, but it seems like you've been avoiding FMCG. So when you say consumption, how are you making a distinction between the two? Are you only looking at the luxury and the affluent plays and not at, let's say, the rural plays?
So basically, rural has been quite it has not picked up for a very long time. Right? In fact, there were green shoots which totally vanished. Our feel is it's a structural play working out in the rural markets because the non-farm labor is not picking up there. Now, that is where the real discretionary spends come in when the non-farm labor picks up. Till then, it's all staples because farm labor has been pretty okay within the rural markets. And non-farm is a play on the unorganized sector, which I don't think is going to pick up in a while from now as such because of formalization of the economy. Yeah, so that's why we are very careful on our plays within FMCG as such. And as you rightly put it, it's mainly the premiumization that you're looking at here. And there also we have only one player, which is in the FMCG part. And that also is not actually FMCG. The most FMCG of FMCG is tobacco. So that's one of the players that we have here. But apart from that, we don't have any other FMCG play as such. So.
Hi, morning. What about defense, railways? Do you think the move up there has been too fast, too furious, or there is still room for more upside?
So basically, defense, I think, has a long-term going forward, it's a longer term play that will work out in defense. And frankly, I mean, our feel is that we have to avoid the cyclicality within defense. And when I say cyclicality, I mainly mean the kind of capacity constraint that most of the players have. So you need to be in plays which are more of a, they're across various services in defense. Basically, electronics is what I'm talking about. And obviously, we're looking at also outsourcing plays within defense as such, because I believe that India will, at some point in time, be an outsourcing play for defense. And frankly, I mean, after all these problems that have come up with Ukraine and Russia and Israel and Gaza, the world has started spending more on defense as such. In fact, the EU, which was earlier very dominant in terms of defense spends, in fact, Germany was the lowest which is spent on defense. They've also upped their budgets in defense. So I think they need to outsource to various countries, and I think India would be one of the fair beneficiaries of this. So you need to work out those plays as such. So it's a structural long-term play. And there again, as I said, that you've got to avoid the cyclicality within, and that's why you've got to be very selective in your stocks in defense.
Then, Joe, so what to your mind should be an ideal strategy in the run-up to the general election? Because it's December now, and May is when the event is. Do you think that markets which tend to rally ahead of the election cycle, they will rally this time also?
So, Nikhil, the fact is that the rally would have happened if there was some excitement going forward as such. I don't think that's happening actually. I mean, our belief is that it will be more of a flat line. I mean, if you split the market, probably it will be into two parts. One will be prior to elections and one will be post elections, because a lot of talk is being said during the. I think the state elections will be an eye opener. Basically, whatever the results come out, that will be interpreted to a larger extent, because this time around, the 5 states which are going to elections, they're totally a microcosm of what our general elections are going to be. 3 states, there are 2 central parties fighting each other. 1 state, there's a central and a local party fighting each other. And the 3rd state, there are 2 local parties fighting each other. So it's like a perfect play to understand what's going to happen in the central elections when they come about. So I think that will be looked forward to fairly closely. If things work out the way the market wants it to be, I think there'll be a rally in the works, some kind of a rally, small rally in the works. But the biggest question would be how the US Treasury yields work out. Though they've softened of late, but I don't think that's going to sustain there as such. So maybe that is what's going to play out. And frankly, I mean, today morning, another overhang. By the way, you said FIIs have been sellers all along, but if you look at the November figures thus far, and if you add the primary markets flow from FIIs, they're more or less even Stevens. I mean, they've sold in the cash market, but they've been buying in the IPO market as such. And today morning, when I opened the paper, I had to go through 5 pages of IPO ads. I mean, full page ads in my Pink Daily, which I like, and then the front page. So that's a big one which is sucking out the money from, I think, the markets as such. So that is what you've got to look up.
Sure, you flipped through the newspaper and also saw lots of headlines on the Tata Tech IPO in particular. 791 crores is what they've raised ahead of the IPO. A lot of marquee anchor investors. Have you picked anything up or looked at any interesting companies? A lot of debuts this week?
Though I would like to comment one on this since now we're running a mutual fund. But no, I don't think we're too excited in the IPO market as of now. So I would rather stay away from that.
What else are you avoiding completely? Where you say, okay, business is bad, valuations are higher, or valuations are higher, but even though business is good?
So basically, Nico, FMCG is one area which you need to avoid. I mean, I don't think sustenance of 60, 70 Ps for most of these stocks, 1 year forward Ps I'm talking about, is possible given that even the rural markets are not firing and the growth rates are in low teens or even high single digits and such. So that is one area that you need to avoid. The second one is outsourcing and mainly IT within that space. Because I think there's a lot of hope trade being played out here that probably there'll be a rate cut happening very soon in the US, and that's why discretionary spends will come back into the IT budgets as such. not happening. I mean, I think December will be again, the quarter will be another eye opener for all the hope trades which have happened, and probably you'll get to see a feeler. So our feel is that FY25, fiscal year 25, is not going to be as exciting as everybody is building in today. But maybe it'll be FY26 when you can look at that space. Then again, paints is one sector which you need to avoid. A lot of competition building in, and obviously the fact that the commodity prices have held them to an extent. But of late, the demand also hasn't been picking up much here. So obviously, the P's there again are sustainable. So these are the kind of pockets that you need to avoid going forward.
There is a
Wherever basically you've seen a froth in valuations without any supportive growth in earnings, I think that's where you need to avoid.
A lot has changed for banks, Dinshaw. I mean, while credit growth is strong, but NIMs are coming under pressure. RBI is saying unsecured loans are too high, they could pose a systemic risk. Banks have been riding on unsecured loans and high spreads. That is leading to profitability. High interest rates have aided their NIMs. All that is history now. So do you think the outlook for banks actually could get dim and the underperformance will continue?
So Nikhil, on the risk weightages, which RBI came back and said that okay, you need to increase your risk weightages for various lendings. I think they went back to the pre-COVID levels as such. So I basically they came back to that. The only thing was they came down heavily on the NBFCs rather than anything else. So that is a good part about RBI. I think they've done a wonderful job in controlling the asset quality within the system as such. So that is one thing that you should look out for. Talking about NIMs, the earnings growth can, to an extent, the NIMs can help to an extent, but actually the real re-rating of the sector happens once the credit growth picks up. And I think that is where the excitement is building in. In fact, last quarter also, mid-teens to high teens was the kind of credit growth that one saw in most of the banks as such. I think that is an exciting part, and it's mainly driven by consumer financing and stuff like that. So it's fairly good. So in fact, that is what our call has been, that if you're looking at an economy which is going to grow, and India is going to grow, the economy is going to be the fastest growing economy in the world, as of that size at least, you need the financial sector to kick in. You need the consumption to kick in. And I think that is what is working out perfectly for us today. And given the fact that we've got 65 odd crore young people, which are aggressive spenders, not all of them will be spending though. But the fact is that is what is the exciting part. I think we'll be right at that point when probably China was in the early 2000s. And I think we are on a very good wicket today. So just taking a phrase out of cricket.
Okay, good to have you on board. Thanks so much for taking time out, Dinshaw. It's always a pleasure interacting with you and understanding your market outlook. 19,799 on the brink of 19,800. So yes, gradually moving from strength to strength. And what's leading the way? Well, when it comes to individual stocks, seeing resilience in some of the large cap names within the consumption space. You've also got an HDFC Life, Cipla, Dr. Reddy's, Sun Pharma. So Pharma is leading the way. Bajaj Auto, Tata Motors, Hero MotoCorp. So you've got strength coming in within the auto basket. BPCL is in the green, and heavyweight Reliance Industries perched at 23.92. So that's stock 2 adding a little bit of fervor. But let's move right on and understand what's fueling competition within the value fashion market, and a status check as well for V-Mart. What's the road ahead when it comes to their business plans? Lalit Agarwal is the Managing Director of V-Mart Retail, and he now joins us on the show. Thank you so much for taking time out. To begin with, value fashion, that's one of the fastest growing categories. And for you, of course, it holds substantial potential. Do you believe that to a certain extent the space is getting a bit overcrowded after Zudio's success with now the entry of the likes of Shoppers Stop, Reliance Retail? Are you worried?
Good morning. The Indian market and the Indian value market, where there is so much of youth power coming in, the market is too large for anyone in the retail business to get worried about. I think this is a great opportunity for everyone. And people are targeting the right market, and people are coming into the right space, which we have been always boasting about. And I think this is what the opportunity is. And most of the retailers are trying to bring in some of new or the other format. There's definitely a lot of retailers in the market today compared to the last 3-4 years back. And that is definitely getting the some market share is happening on that. But there's no worry. I think there's a huge demand which is waiting for every kind of consumption, and that consumption is also growing as we were speaking, and as we're hearing also the earlier speakers. And I think that's what India is all about. That's what Bharat is all about, and that's the opportunity that we all bring in. And I think the kind of aspiration that Indians are showing up and the youth of India is showing up. This definitely is a great opportunity for everyone in this value fashion market. And this whole social media, this whole fashion, this whole Gen Z which is coming in, this whole consumer base which is getting targeted. This is something which is only to India, and that is the uniqueness that India has, and the Indian retailer would have in the global scene.
Sure, but you're talking about recovery happening, and you had earlier hinted that Q3 will be the quarter when you will see recovery, because if I look at the numbers, your losses actually in the quarter gone by expanded to 64 crores despite the kind of demand momentum you're talking about. When do you envisage your earnings performance to improve then?
I think that those losses that we have reported are a part of our own strategy, and wherein we have acquired some multiple companies, and we also invested into our online retail, and then that's why. And then the Q2 normally is a little bad quarter, which we always know. But yeah, Q3 is going to be a good profitable quarter. We'll see some good profits coming in. Don't worry about it.
Demand comeback post Diwali. Are you getting a sense that there is more surprise and there is less disappointment?
No, I think there is a demand. There is a good demand that we are seeing versus the previous quarters. The Diwali to Diwali, that we are able to see some growth as well. But still, our expectations are still higher, and we need that growth to go up a little more, which still we are not able to get those. But yeah, I think we are seeing positive signs. We are seeing good recovery coming in.
Give us an absolute number. Let's say how different this Diwali was. What happened to the industry? What happened to your own sales? So that we get a sense.
I think Diwali for most of the retailers has been good because this time it has also been a winter Diwali, because the Diwali has moved into November, mid-November this time. So that also is impacting some of the bringing in some of the winter sales a little more early in the festive period. So festive period we are seeing some growth, but overall when you compare the entire quarter, we may see a little lighter growth is what we are seeing. But yeah, the next 1 month is also very good time which is going to come in, where a lot of weddings are there in the market. So we are expecting a lot to come out of this next 1 month as well.
You're a value retailer. That's what you were specialized in. And when it comes to shopping in a small town, it is almost like a celebration. But the celebration this year has got marred because of high inflation and unseasonal rains. Do you think going forward that effect will normalize?
See, I mean, what I understand, definitely in the small town or for the consumer who are in the lower middle income group, celebrations are the ways of life, and the way they want to live their life, and they want to celebrate the life with their family, with the new clothes, with their new things in the house. So there is celebration which is going in. Definitely, there are constraints, and there are constraints which is not allowing them to celebrate fully. And those constraints we have been seeing for the past 2-3 years, right from the COVID times. And I think there is a lot of recovery which has happened since then. There is more recovery which is going to come in. There are disturbances which are happening, especially in our heartlands of Uttar Pradesh, Bihar. These places we have seen some rainfall issues. The monsoon has also not been very consistent. But still, whatever we have seen, the produce has been good. The farmers are happy. The farmers are getting good prices for their produce. So the overall economy seems to be a little positive, and we are expecting a lot of recovery coming in.
Okay, you're expecting a lot of recovery coming in, but you'd also taken, a lot of strategic initiatives that you were talking about, change in the buying process, vendor selection, and you have stated in the past about the correction in pricing to attract customers as well. Given all of this, where do you expect your margins to trend from here on?
I think we have been we have been the most valuablest player in the market. We have been catering to that particular mass audience who earns between 20,000 to 50,000 rupees. So the expectation from that particular audience is to get the little real value. And that is where we were specialized and we are specialized in. So of late, for the last 2 years, we saw a lot of inflation coming in. The price went up. We brought it down. We compromised with our margins in the last season, which was the spring summer season. But this particular season, we have now worked on a lot with our vendors, with our sourcing and buying and our designing philosophies and the processes. And we have actually improved on certain margins there as well. And the product lines and the product quality, the product, the designings, the product type. So all of those has got improvement. So all of those results we'll be able to see. Finally, the results will come only when you are able to sell off the entire inventory, and the inventory sell-through has to be also very good. So that's how retail and the fashion business is all about, because it's just not about having the margin in the fresher season, but having the margin in the entire season. And that's what we are also targeting in keeping the inventory in control. So all of these going together, I think we are seeing betterment, and we have seen some betterment. So margins are also going to be improved. The margin will look improved in this particular quarter.
All right, good to have you on board. Thank you so much for taking time out. That's the view coming in from the management of VIMA, talking about good profitability in Q3 and how they are seeing, as of now, good demand, not worried with respect to competition. Tell you what, we will take let's just focus in then on the management of Tata Technologies, the first Tata Group IPO in the last 2 decades. And Warren Kevin Harris is the CEO and Managing Director, Tata Technologies, here to talk with us about the business and lots more. Good to have you on board. Thank you so much for taking time out. Now, your growth rate has been slower than your peers over the last 2 to 3 years. A, what's the reason for that? And B, do you think that you will outpace them in the near future?
I think if you look at the numbers, 2 years ago we grew the business by 48%. Last year we grew the business by almost 25%. In the first 6 months of this year, we grew services by over 21%. So I think that if you look at a comparison between ourselves and our peer group, I think our growth rates either meet or exceed the competition. So we've been pleased with the momentum that we've established, and we're working hard to ensure that we sustain that.
Sure, so your growth is in line to your peers and you're expecting to sustain that. But I also want to talk about your client mix. Right now it's 35 to 65 with respect to Tata versus your rest of the external clients as well. Going forward, is there an ideal target mix that you can guide us for? Is there, because it has its own pros and cons, what's the ideal target mix for you?
I'm not going to put a number on it, but we would expect to grow our business outside of the group at a faster rate than we will grow the business inside of the group. No, Tata Motors and JLR are doing very, very well at the moment, and so we may see an uptick in the percentage contribution from those customers in the next couple of years. But I think medium to long term, you'll see the trajectory continue that we've established over the last 10 years.
Okay, so you're expecting a faster clip of growth for external customers versus Tata, and that is the shift you're expecting in the client mix as well. But the other thing naysayers are talking about is the fact that how Tata Tech is into, vanilla body engineering, product development and testing kind of services, whereas the likes of KPI Tech is more into embedded and digital solutions. What would be your response to that? And are you looking at moving up the value chain in terms of offerings as well then?
What I would say is that when you're entrusted to develop a complete electric vehicle, you have to have capabilities across the entire value chain. That's not just mechanical systems; it's also software and embedded electronics. And from the perspective of the breadth and depth of our capabilities, we believe that in the automotive business we're a match to any of our competitors. We have concept engineering capabilities, we have mechanical capabilities, but we also have software and embedded capabilities that are a match to anybody in the Indian engineering service provider arena. I think the thing that differentiates us is our ability to be able to integrate those technology solutions with mechanical systems and position support for our customers in the context of delivering entire subsystems and work packages all the way through the delivery of a complete vehicle. We think that that's a difference that matters to our customers, and we'll continue to build a moat around those capabilities.
Point taken. That's the word as far as how you stack up versus rest of your peers like KPI Tech and LTTS, Tata Elxsi, etc. as well. But auto ER&D, that's the space which is seeing a lot of spend. Where would you say we are in the spend cycle right now? How long do you see it sustaining, and are we nearing the peak at all, would you say?
I don't think we're anywhere near it. I think we certainly are, driving disruption and change around the move to autonomous, the move to connected services, the move to alternative propulsion systems and specifically electrification, and the move to shared mobility. But I believe that we are right at the beginning of that journey. We've seen very progressive companies like Tesla and the new energy vehicle companies in China and the United States, drive the type of change that everybody else is now looking to emulate. And I think again, we're right at the beginning of that. And as the clock speed of technology change continues to accelerate, what we expect is the customers that we're working with to look increasingly to the outside to get access to the skills that they're going to need. And that is going to provide significant tailwinds for our industry, for Tata Technologies, and specifically for companies that are based in India. We believe that India's demographic advantage, we believe that India's heritage in terms of delivering professional services at scale truly differentiates the region and those companies in it.
Okay, so Warren, that point is taken, but you talked about Indian talent. But one of the ways the global companies are looking at tapping into that is by setting up their captive GCCs in India versus outsourcing that they do usually through you. Do you see that as a big threat, that the companies will set up their own units rather than coming to you?
I certainly think that anybody that is going to be in the product development business will have to have a meaningful nexus in India. I do not think it's a choice anymore. But I think that those companies like ourselves that have grown up in India, that understand what it takes to be successful in India, particularly as it pertains to attracting and retaining the best talent. I believe that we have an advantage that will be very difficult for GCCs and for foreign ESPs that want to come into to India to invest. We're not complacent about the challenge or the threat that they represent, but we are certainly confident in the advantage that we represent.
Sure, but within aviation, can you also clarify about Boeing? Is that expected to be onboarded as a client, and to your overall product mix, will you be diversifying maybe beyond aviation and transport?
Well, let me start with the question around our customer base in aerospace. We're bound by client confidentiality agreements, and so I can't be specific about the customers that we are working with outside of those that have given us permission to talk publicly. But we are connected and involved with the largest and the most progressive players in aerospace. We believe that business with those customers will continue to grow. And although our business mix at the moment is kind of 90-10, with automotive obviously being the largest, over the next 3 to 5 years, we would expect aerospace off a relatively small base to grow at a faster rate than what we're seeing in automotive. As far as interest outside of the 3 industry verticals that we are currently involved with: automotive, aerospace, and transport, construction, and heavy machinery. And typically, transport, construction, and heavy machinery lags automotive by 3 to 4 years. And so we're starting to see the same sort of demand around alternative propulsion systems, specifically in connected services there, that we've seen in automotive.
Sure, Warren, but shifting focus to the IPO specifically, it is a complete OFS, right? And you have decent amount of cash lying on the books. What would be using that cash for? Are you looking at some acquisition, or you've had the history of buybacks and sizable dividends? Is that likely to be the course of action in terms of capital allocation policy?
That's a question that obviously the board will make a decision on. But you're absolutely right. We have a track record almost since the formation of the company for delivering back value to shareholders, either through dividends or more recently we've done a couple of buybacks. I would expect that to continue. We've done acquisitions in the past where it makes sense. We'll be open to that in the future, where we can accelerate capability, or when we have the opportunity to enter a new logo that we are attracted to. We'll certainly be open to doing that inorganically, and we expect the business to be somewhat balanced in terms of the capital we put to work to grow the company and to build out our value proposition, with the responsibility that we have, the continuous responsibility that we have to give back to shareholders when it's appropriate.
Right, and given that margins are close to the industry average from here on, do you see levers like onshore, offshore, maybe automation for margin expansion, or is it realistic to assume the current range that you have will be maintained?
No, I'm never comfortable with our as is condition. I always want to drive improvement, and we certainly think, as far as margins are concerned, that there is incremental improvement through operating levers. We are at the moment 50-50 in terms of onshore, offshore revenues. We are not an India out company. We are a very balanced onshore, offshore company. We represent a global proposition, and we think that there's the opportunity to grow our offshore contribution to the sort of 65-70%. We don't think we'll ever get to sort of the 80-20, 90-10 positions, because of the nature of our value proposition. We are in the business of turnkey delivery of complete vehicles, and when you are entrusted with the family jewels of a manufacturing company in that way, you have to deal and interface with all of the various stakeholders. That requires proximity to our customers, and we deliver that through our onshore teams, and that's a great complement to the work that we do in India and in Eastern Europe.
All right, appreciate you taking the time out. Thank you so much for joining in. So that is the CEO and the Managing Director of Tata Tech talking about how they're hopeful of sustaining their growth rate. As of now, they will be maintaining their record as well of returning value to shareholders. Acquisitions, they are open to it depending on the value that brings to the board. With news that we're above the 19,800 mark, we'll take a very short break. Be right back as we discuss the Tata Tech IPO in greater detail.
Okay, now let's get an analyst view for our viewers on the Tata Tech IPO. After 20 years, the Tata Group of companies going public. It's not a very richly priced IPO. So I've been for bumper gain, and then perhaps more after that. Could it do what, let's say, a DMart did, which is it was expensive, but then by the time it peaked out, it went from 600 rupees of a listing to about 6,000 rupees. So is Tata Tech in that kind of a big, listing, which is just going to light up the screen and which is just going to, give a big, opportunity for investors now to participate? Dhananjay Sinha and Siddesh Mehta, they both join us. Let's take our conversation forward. Dhananjay, I guess it's like a no-brainer that you need to apply. Now, the point is that if you don't get lucky and if you don't get the shares at the IPO, and after a gap up listing of 20 to 30%, should one still buy into it?
So I think in terms of valuation, I think it's fairly cheaply priced. If you look at the comparison with respect to its competition, I think the closest competition we have is KPIT. Others we have as L&T Technology and Tata Elxsi as well. So if you look at the comparison, KPIT on FY23 basis is priced at 75 times PE, And if you look at the offer price for the IPO, it would be some valued, I would say. I would say also, if you consider the market cap to sales ratio, I would say in comparison with others such as KPIT, L&T, and Tata Elxsi, Tata Technology is currently priced at 4 times. So that's again fairly low. KPIT. I think so there should be a good subscription to this IPO. And
There is a bit of a video lag there. Siddesh, what is your sense? I mean, it's like a must subscribe, but post that, is it a must buy even if there is a gap up listing?
So the Tata Technologies IPO garnered significant attention following the filing of its DRHP, and today it has made its debut on Dalal Street. The earnings valuation is a relatively cheap valuation. We can also say that the IPO is coming with an attractive valuation and not with an aggressive valuation. So with a long-term perspective, we can subscribe to the IPO even after a big gap up, because the Tata Group has its name, it has its legacy.
My question is, would you advise your clients to buy it even if there is a gap up listing of 20-30%? Because IPO subscription, I think not everybody will get lucky when it comes to allocation.
Yes, if the investors are investing in the Tata Technologies IPO with motive of listing gains, then they should not enter the IPO if there is a big gap up. But if they are entering with a long-term perspective, then the IPO is worth investing for the investors. The investors should not miss this opportunity.
Is Dhananjay back? Can we go to him? Okay, Dhananjay is not back. Okay. What do you think is going to be the 3-year or 4-year outlook for, let's say, Tata Tech IPO? Could it do what Tata Elxsi has done, what KPIT has done? What's the benchmark according to you? Siddesh, the question was for you.
Okay, so the company has diversified global presence. The client portfolio includes Tata Motors, JLR, Airbus, McLaren, Honda, Ford, etc. Global spending on ER&D segment it operates is expected to grow at a compound annual growth rate of 10% over the next 5 years. Tata Tech is the only Indian firm and among a handful globally that serves automotive clients in every stage of product's life cycle, from the drawing board to the showroom floor. So now the firm is expanding into aerospace through anchor clients, and the long-term perspective looks attractive for Tata Technologies also.
Point taken. We let you go on that note. Thanks so much for joining in. So that's the latest coming in on Tata Tech. Of course, yes, right now the exposure to aviation is limited to 10%. Almost 75 to 80% comes from auto. But we did have the management speak about how aviation is expected to grow at a faster clip, because they were talking about the recent association that they have done with Airbus over the period of next 18 months. And more importantly, the entire group's focus coming back as far as aviation is concerned. We have known and seen the large order that Air India has also put in as far as the aircraft is concerned, and all of that means that the presence of the group in the aviation sector will actually increase, and that could be one of the fillip as well. This is of course a complete OFS. None of the money is actually coming into the company, but they actually don't need the company at this point of time. The rationale that the management did tell us with respect to the pricing as well as the requirement of IPO was that they're looking at perhaps stemming the attrition, because the attrition for the company is still high at almost 24 to 25%. But as for KPIT Tech, etc., it's lower. They're also looking at building the brand value as well when it comes to competing with rest of the peers, because if you look at the valuation and the revenue profile is actually higher than the likes of Tata Elxsi and KPIT Tech. Their revenue is close to 4,500 crore rupees versus the others, which is still between 3,000 to 4,000 crores. So overall, Nikunj, of course, we have seen IRETA coming up with a thumping subscription figure, and for Tata Tech as well, if you go by the grey market premium, it's almost 60 to 70% versus the issue price.
See, Nisha, all Tata group of companies right now are the flavor of the season. They, irrespective of whether it's a retail company, FMCG company, even for example a company like Trent, 100p, unheard of, right? Titan, 70p, Tata Consumer, not the best in terms of return ratios if you do a peer-to-peer comparison, yet the P multiple is higher than HUL. So they are commanding a premium. Within that, if a Tata company goes public after 20 years, there would be significant amount of interest. If you put two and two together, assuming that this is a high growth business and it will continue to command a P multiple which will be higher than the industry average, and then this is going to be linearity in making in terms of manufacturing and where AI is moving, then this is one of the portfolios you would say, look, you want to keep, you want to hold, and you want to see. There are times when great companies, when good companies, they go public. The trick is not to just get happy with a 20% pop-up. I think DMart issue price was less than 500. It opened with a 100% premium at 600.
Yes.
Right? And it went to 6,000. At 300 it was expensive, 600 it was more expensive, 600 wildly expensive. But the journey from 3,000 to 6,000, for those who believe that, okay, here's a great guy who runs a great company, he's a great investor, he understands business, and the reason why he's a great investor is because an understanding of businesses is so great, Radhakishan Damani, then you just stay at cost. So Tata Tech IPO perhaps could be looked at the same prism. Tata group of company, high growth business, P multiple cheap, and if you keep it for 4-5 years, can the magic happen?
Yeah, so it's ticking all the right boxes. Question is if investors actually manage to get their hands on it, but yep, long-term story looking very promising. Well, speaking of action within the primary markets, then let's focus in on IREDA, the Indian Renewable Energy Development Agency as well, which has got a pretty stellar response on day one, being oversubscribed. Let's understand the business a little bit more, capex, utilization plans with Pradeep Kumar Das, who's the Chairman Managing Director, now joining in. Thank you for taking time out. To begin with this fresh issue, what is the outlook in terms of your growth runway? What is the reason for opting for this IPO?
Thank you, Aisa. First of all, let me thank you and thank your channel for inviting me. And this is the first interaction in your channel with respect to our IPO. And we are working in this space, pure play green financing, since 36 years. And if you see our net worth in September, it is 6,500 crore. And we can go roughly to 7 times of our capital gearing of net worth fund as per the RBI healthy compliance norms. And we need to ensure not only minimum 15% CRAR, ideally at 17%, in order to ensure that we continue to maintain the AAA stable rating. So this 12,900 crores of additional equity, that will enable us to again 7-time leverage and enable us to further finance in this space. If you see last 3 years of CAGR of our loan book addition, it is more than 30%. And if you see the sanctions and disbursement, CAGR is 72 and 56%. So which means we have tremendous potential to lend, and we only need to augment the supply side, that is the borrowing side. As of now, our loan book is more than 47,000 crore of September audited data. And even in March also, we had crossed roughly 47,000 crore. And we need to keep on add further. And if you see, this is a 36-year-old company. 3 years back, our loan book was hardly 23,000 crore plus. In last 3 years, we have added more than 24,000 crores. That means renewable energy sector is requiring quite a lot of support from us, because we have been handholding the sector since last 36 years. And in the country, last 9 years, the renewable energy is growing in a jet speed. And if you take the example only of solar, last 9 years, 25 times of solar growth has happened. And now the solar, wind, hydro has become quite a traditional kind of thing. And in emerging space, we have the time now for new and others like ethanol, compressed biogas, even manufacturing of solar components to make Atmanirbhar Bharat, not only to make Atmanirbhar Bharat self-sufficiency, but also to support the export market, what competence we are having. In addition to that, the new and other emerging is storage, be it pump storage or battery storage, be it offshore wind, be it green hydrogen and its derivatives. So demand side is pretty good for us. And since we are pioneering this space and kind of single-handedly shouldering the responsibility of RE growth in the country for more than 2.5 decades, and last 7 to 8 years, others have come into this space. They are largely coming in the traditional RE space, where the fair amount of asymmetry information is over. and risk metric is fairly known. Unlike us, we have always taken the challenging and emerging sector. In addition to that, in last 36 years, if you take till up to September, we have financed more than 1,07,000 crore, and our cumulative write-off is just 203 crore, which is less than just 0.2% of it. And largely, we are lending in private sector. Even if you see September data, our loan book 77% is private sector, and 23% from the government sector, which includes state utility and central utility.
You know, allow me to come in here. I want to understand a little bit more on your spreads because that has come under pressure due to a decline in yields. Just a quick word on the outlook on your yields.
See, anything above 3.5 of NIM is quite comfortable for us. And again, if you see, we may maintain a basket of mix of RE assets. Today, if you see, 62% of our assets are traditional RE, that is wind, solar, hydro, out of which if you see, the 80% of the project are commissioned asset, which indicates where we have lesser NIM supported by lesser provisioning coverage ratio. If you see our PCR is around 46 to 48 against the normal thermal projects financing companies where it is more than 70 plus.
You are investing in a sector which is the sunrise sector, but technologies, they keep on changing here. For example, if you let's say would have done financing to the solar company 5 years ago, the rates have come down from 15 rupees to 3 rupees a unit. Isn't that a risk right now that the sector in which you are financing, there are a lot of changes which are happening and which just changes the business model?
First of all, being a lender, when we are lending, all the mathematics are known because once the PPA is in place and all the mathematics are known, and once the project is commissioned, typically in case of solar and wind, it takes hardly 6 months to 1.5 years to commission the project. And we have the construction period is very less. And since we are having the expertise, our support to the sector, our turnaround time is quickest, where the project construction time even reduced to the developer when they have taken the support from us. So once we have financed those mathematics in place, and this PPA and others are sacrosanct, only one case where the state government has decided to dissolve the PPA, but that has been already sorted out through code. So as you are saying, the technologies are changing, but once the PPA has been signed, the cash flow is going to be coming with respect to that PPA rate. And more new projects are coming. So while we are financing, that risk period of 6.1 to 1.5 years as a lender, we have to see what kind of price other things can happen. And if you see largely, as on date, even almost 90% of the projects components are import. And
how are you different from, let's say, banks? Because SBI is also saying that we are lending in the renewable sector. REC PFC is also saying that we are doing the same and we are increasing our exposure to new energy sectors. How are you different?
See, if you see, the future is renewable energy, not thermal. We need to keep thermal only for having the base load factor and to peak load balancing. So therefore, all along REC PFC, they have handholded to ensure that energy connectivity as well as energy supply to each and every household in the country. That phase is over. Now the next stage is how to ensure around the clock power as well as the objective of not only supporting power, how to decarbonize and energy transition. So today, even IRERA's focus is also not only renewable energy development support, also to decarbonize and energy transition. Because the Panchamrit target, what we have, our Honorable Prime Minister has committed in the POP program, not only 500 gigawatt of RE installation by 2030, but also the NDC target also we have to achieve. So what it means, another additional 320 gigawatts of RE is to be installed. At the same time, approximately 30 to 30 gigawatt of thermal is going to be installed. Now, if the future is largely from renewable and new sources, then REC PFC's future business also has to come there. And you are right, bank and others, they are coming. So they are coming largely in the established RE, that wind, solar, hydro, which even if you see 10 years, 15 years back, nobody was coming. And when I'm talking hydro, small hydro, because large hydro was not RE earlier. Post November 2019, redefining the RE in India, this large hydro was brought into this basket. So the portfolio of those companies who was lended in that space, that is they are showing it a larger space. But if you see in true sense and spirit, which was India's earlier definition, it was we who was largely lending into it. And again, any bank or generally in banks, they have some project financing. Then within that, they have sectoral caps, be it for power, be it for others. So when the lending happens, they retain themselves with that. And then as long as they are not very comfortable, they will not be coming forward. I can share with an example. If you look at the manufacturing of solar modules and sales, or even now, Government of India has come with PLI schemes for integration of entire facility, so that the entire components of the solar can be manufactured in India. And in 4 years down the line, we are targeting to have at least 100 gigawatt of installed capacity, not only to supporting within Indian projects, but also to export market. But there, you will not find much lender available in that. But if you see, look at us, we have more than 2.5 decades to almost 25, 27 years of expertise in this lending to the manufacturing. And if you see our prospectus, what we have published,
Right.
two of our borrowers are there since more than 2.5 decades.
No, sure, point taken, Mr. Das. Appreciate you joining us and, candidly talking about your business outlook as well. And of course, we have seen a lot of interest for your IPO, so good luck on listing as well. But time now to shift focus and get you some chartbuster ideas from our technical experts. Kunal, you go first.
Thank you so much for that. So, the charts which I'm looking out for is on the mid-cap front again, City Union Bank, and the indicator which I'm looking out for is a golden crossover. So, in simple technical terms, we look out for golden crossover as a crossover of a 50-day moving average towards a 200-day moving average. Now, historically, this has worked out very well for City Union Bank. This was in August 2022 when the stock had given a golden crossover, and from the point where the stock had given a golden crossover of 150 approximately, in a matter of 3 to 4 months, the stock went up to as much as 200, 205 levels. So that's a decent return of more than 30-35% in a very short span of time. Now, this is a bearish crossover for the stock, and we've seen what has happened to the stock when it went through a bearish death crossover when the 50 DMA crosses below the 200-day moving average. Now, interestingly, on the positive side, the stock has given a golden crossover yet again. So, closer to this 140 odd mark is where we've seen the breakout happening for the stock and the golden crossover for City Union Bank, which means that even if you look at the historical context for the stock price, we could be looking at at least a 30 to 40 point upside for the stock over the near term, which means closer to 170 as a near term target for City Union Bank.
Okay, that's the view coming in terms of the long-term target price from Kunal. Naresh, let's discuss your stock and its KNR Construction.
So KNR Construction has been consolidating and making tops around the 280 mark, around this trend line. If you see, for the last 1 year, this is maybe the 6th attempt or a little more. So finally, the stock has broken out after 5-6 attempts. Good volumes in the last 3-4 sessions. So in this move from 265 to 295, the volumes have been highest in the last 2 years. So a clean breakout, expecting this to go towards new 52-week highs and all-time highs. And accumulated 290 to 305 levels, stop loss at 280, target price of 350 to 400.
So let's get some other stock ideas as well. Kunal, what's the mid-cap cracker idea?
So, not a mid-cap as such, but Tata Steel is something which I'd be bullish on from current levels, expecting this metal major to head into a breakout. So, 134 is the target, stop loss 122. And the second would be about BF Utility, something which I've been bullish on over the last few days. It's moved up from 650 levels to 700, would revise the targets higher to 750, stop loss at 675.
All right, let's nail it down then. Naresh, to your top calls.
So first would be a buy on Cipla, which has given a fresh breakout. The whole large cap pharma looks interesting. Stop loss at 1260, target price of 1350. Second is a buy on Ashok Leyland, which has seen good volumes in the last 2 sessions. Stop loss at 175, target price of 190.
All right, there you have it. Those are your top chartbuster ideas being flagged off by our chartists. Tell you what, we'll take a very quick break with news that the markets are in fine fettle for now, at least the frontliners at 19,818. Be right back with more.